Hi, and welcome to today's Engaging for Missouri webinar. I'm Alice Roach from the Division of Applied Social Sciences at the University of Missouri, and I will be your host today. With each of these 30-minute webinars, we intend to share research-based insights that leaders like you can apply in your own work to benefit and strengthen the state's agriculture and food system, hospitality sector, and communities. Today, Dr. Pat Westhoff will present an updated outlook for agricultural markets and farm income. Before I invite him to begin, I want to share a few housekeeping notes. First, we'll close the webinar today with a question and answer session. Those of you who connected to today's webinar via your computer can submit your questions in the chat screen. So to open the chat, just click the chat button that you see at the bottom of your Zoom window. If you joined today by phone, then you can email me your questions at roacham@missouri.edu. Second, all attendees are muted and may not start their video. Third, if you encounter any technical problems during the webinar today, then you can let me know by either submitting a comment in the chat screen, or you can also send me an email at roacham@missouri.edu, and I'll do my best to help you troubleshoot. Fourth, we will make a recording of the webinar available to you. You can look for an email from Zoom that shares more about where you can access that recording in about a day from now. Also, you can find an archive of all of our previous Engaging for Missouri webinars on our division's YouTube channel. So now we'll transition to the topic of today's webinar, which is titled An Updated Outlook for Agricultural Markets and Farm Income. Presenting is Dr. Pat Westhoff, who is the Director of MU's Food and Agricultural Policy Research Institute, and he's also the Howard Cowden Professor of Agricultural and Applied Economics. So thank you, Pat, for being here to present. If you could please unmute your microphone, then we can begin today's presentation.
Morning, Alice. Thank you very much for the opportunity again today, and welcome everybody. So we're going to talk about a variety of topics today. I want to spend a little time talking about some of the news items. Yesterday, of course, we had some major USDA reports became available. So we'll talk about those a little bit. We'll spend most of our time talking about our baseline outlook for the farm economy. And then if time permits at the end, we may come back to some additional issues in the news. I'm operating off of my cell phone's hotspot today, and I see things are a bit slow. So I'm currently stuck on the first slide. There we go. So there's the agenda again. So we released our baseline update on June 9th. It's available at our website, FAPRI.missouri.edu. I'm going to talk about the outlook for the general economy, agricultural commodity markets, government program costs, and farm income. And if time permits, again at the end, some other recent news. So let's start with yesterday's Acreage report. It's probably some important news that's going to affect the way the world looks over the next several years. Back in March, when farmers were surveyed, they said that they intended to plant 97 million acres of corn this year, a big increase over last year's acreage that was reduced by all the flooding problems we had in the spring. In our baseline update I'm going to talk about, we assumed that the actual acreage would be a little bit less than that because we thought that given where prices were, people would want to shift some acres away from corn and towards soybeans. So we came in 1 million acres below that intensive report on our projected corn acreage, and 1 million acres above what that report had said in terms of soybeans. Yesterday's report was a bit of a surprise. It was actually below market expectations by a fair amount. And so the actual acreage number came in at 92 million acres this year. So 4 million acres less than we had assumed on corn. It isn't really made up elsewhere. There were actually a little bit less soybean acres than we had anticipated, very similar to what had been in the intensive report. Likewise, a very slight dip in wheat acreage relative to the intensive report and to our expectations, and a 1 million plus acre drop in cotton acreage as well. So overall, there was a few million acres less being planted this year than farmers had indicated they planned to plant last March. But some of that can be attributed to some weather concerns we've had. North Dakota, for example, is going to plant a couple million acres less this year than they did in 2018, in part because of flooding problems and the inability to harvest last fall, and some other issues across the country as well, plus low prices have all conspired to drive down acreage a little bit. So the market response to this yesterday was, kind of as you'd expect. The fact that there was less corn being planted than expected pushed prices up. There was a countervailing effect, though. The stocks report that was also issued yesterday showed there was more corn in storage than had been expected, so that would have pushed the opposite direction. But the net effect was a 16-cent per bushel increase in prices yesterday on the Chicago Mercantile Exchange for December contracts. That's a 4.7% increase in one day. For soybeans, the stocks report was pretty much in line with expectations. Acreage report not a huge change, a little bit lower than expectations. And once you throw in the higher corn prices, November futures were up 21 cents yesterday. So again, that's yesterday's news. Now I want to talk a bit about the update we prepared for release earlier this month. One of the important assumptions we had to make is what's going to happen with the economic recovery. And of course, none of us know for sure. We used some projections from IHS Markit, a private forecasting group. They showed a 7.3% decline in real GDP in 2020. They do show the economy recovering in subsequent years, but it takes until 2025 before we finally get GDP back to the level it would have been had we simply continued 2% average annual economic growth from 2019 forward. So again, it's not a V-shaped recovery, I think you could probably safely say, but we do actually get back to where we would have been in a few years' time. So that's important to remember. That drives a lot of our demand for agricultural products, has widespread implications for the farm sector. I think that's very important in terms of assumptions is just how much driving people are going to do this year. And again, this is one where there's lots of uncertainty. We know what happened the last several months, a very, very sharp reduction in people's driving, especially during the month of April, with some recovery in May, and we'll see where we go from this point forward. But for the year as a whole, we've seen a little bit less than 130 billion gallons of motor gasoline being used for the year as a whole, a significant drop from what it would otherwise have been. And maybe some recovery in 2021, but not getting all the way back to the 2019 level. Over time, we expect that to level off, maybe even decline a bit as we go to more fuel efficient vehicles across time. Not surprisingly, since almost all the ethanol we use in this country is used in 10% blends with gasoline, you see the right-hand chart looks like the left-hand chart, just the scale is different by a factor of 10. So again, this year's reduction in motor gasoline use means a lot of this ethanol is being used as well. If we see that recover in 2021, we could see that bounce back as the gasoline use does. That has big implications for corn demand and for prices across the board. So let's talk about the corn outlook. So back in January, we prepared our first round of baselines for the year. And the one that I'm reporting in the red line here is one that includes some possible effects of the phase 1 agreement with China. So that the combination of a reduced crop in 2019, increased demand because of the phase 1 agreement, and continued strong growth in ethanol and other uses of corn result in the price path in red there. But now with the lower demand for ethanol, the weaker economic situation, and all the other things that have happened since January, our June estimates were for a significantly lower price path, well below USDA's even 320 per bushel they projected for the 2021 crop. We see some recovery thereafter, but we never really get back to where we were in the January baseline for a variety of reasons, including a large stock buildup that occurred in our baseline. If you compare that to where futures markets were yesterday afternoon, there's always a bit of a basis between futures and the average farm price, but it's not as wide as the gap shown in this chart. So the December 20 futures contract yesterday closed around 350 a bushel. That's a lot more than our price projection of less than 310 a bushel for corn, even when you account for normal basis. I do think with the acreage number coming in where USDA is currently estimating now as of yesterday, that would have tended to bump up our prices a bit and probably bring them more in line with futures once you account for that normal basis between futures and farm. On the soybean side of things, again, one of the big news items, of course, what's been happening to trade with China. Back in 2017, most of our exports of soybeans went to China. The average soybean price that year was $9.44 a bushel. By 2019-20, if you look at the first 8 months of the marketing year, you can see that we've had a big change in the relative trade shares. While China's exports to China are up this year compared to the same months a year ago, they're well below what they were in 2017, in spite of the phase 1 agreement and attempts by China to ramp up its purchases this year. The average price for the first 8 months of the marketing year was $8.56 a bushel, an 88-cent drop relative to what it was 2 years ago. We'll see, of course, where things go. In front of us, the development on the phase 1 agreement is a huge part of the soybean outlook going forward. So if you look at our soybean price projections again, with weaker economic demand, with demand from the general economy, causing some scaling back of livestock production, some other things that would tend to also pull down soybean demand around the world. Our price projections were noticeably weaker in our June projections than they had been back in January. If you compared to yesterday's futures, the gap between futures and the farm price is not that terribly different than it was in the case of corn. So it's a bit more than normal basis would be. So again, the market's adjusting a bit higher price than what our projections were, but the same basic story going forward. That prices remain well below the peak levels we saw just a few years ago, unless demand's a lot stronger than currently anticipated. We'd expect that to be the case. The big picture on the livestock side, of course, is that COVID-19's had huge impacts. The packing plant closures and slowdowns reduced demand and prices for live cattle and hogs. It resulted in shifts in where people buy their food, as demand was reduced for cuts that are used by restaurants, boosted demand for cuts that are purchased in supermarkets. The actual prospective reductions in income affect what people can, they're willing to buy, not just here, but around the world. But of course, there's more than just COVID-19. African swine fever reduced China's production of pork and result in a big increase in imports, as we'll see in a second. And there's lots of longer run concerns about what happens with meat alternatives. So to get a flavor for just how important the Chinese part of the story is here, a chart showing the levels of production and consumption of pork in China in the blue and red lines. You can see that in 2020, we've seen a very sharp decline over the last 2 years in projected production levels and in use levels as well. Yes, imports are up in the red line in the bottom there. They're up very dramatically, in fact, but it's still a very small share of overall production and consumption in China. Just the decline alone in Chinese pork production in 2018 and 2020 is larger than total US pork production. So in other words, if we shipped every single pound of pork we produce in this country to China, all that would have done is get them back to the 2018 level, not even get them back to the 2018 level of consumption in that country. While that red line may not look very dramatic in this chart, it makes China the largest importer by far, and certainly the main reason for a bit of an uptick in our exports of pork this year. So looking at a supply and demand table for pork, here's on the left-hand columns are going to be USDA's estimates for 2019 and their estimates from earlier this month for the current calendar year. And then the projections put together by our colleagues at the Ag Markets and Policy team, Scott Brown and Daniel Madison, for 2020 and for 2021. You can see that Scott and Daniel are just a little bit more optimistic about production levels this year. So we'll get back to more normal levels of slaughter in the months ahead, and maybe even have a big fourth quarter yet in front of us. While we have a relatively similar story on the trade side to USDA, we do think that demand could be a little bit higher than USDA is currently saying, just a very slight dip relative to 2019. The price, on the other hand, comes out very similar to USDA's price, right around $43 per hundredweight for the live weight price of hogs this year. See, 2021, you have a little bit further increase in production, not a lot of change on the domestic consumption side, bit of an uptick in exports, and price again remaining around the $43 mark. On the beef side of things, again, likewise to our pork story, Scott and Daniel suggest that we might have a little bit more production of beef this year than USDA was saying earlier this month. Very comparable to the 2019 level production for the year as a whole. Exports are relatively consistent with USDA's figures and consistent with year-ago levels. And basically exports and imports about the same quantity. Domestic consumption very similar to year-ago levels, but the price a bit lower, and partly because this weaker demand because of all the packing plant problems we had for the last several months. See, for 2021, not a lot of changes in the overall figures or in the prices. In terms of what this means for the overall effect on the farm economy, one of the big stories, of course, is that we've had a big increase in payments this year. Because of the lower prices caused by the COVID crisis, there was a judgment made that government needed to step in and do something about that. So the green bar is going to be the $16 billion CFAP payments that USDA has promised this year. About $5 billion of that payment has been paid already. We don't have any inside information about how much will be paid when, but the assumption here is that the full 16 will be paid eventually. The blue part of the bar there is going to be the MFP payments, the Market Facilitation Program payments, to see how large those were in calendar year 2019. The figure for 20 is not showing you any new payments, but rather payments that were made in the first couple months of the year. We're not making any judgment one way or the other about what will or won't happen in front of us, but the assumption for the baseline is, again, that there's no additional payments beyond those currently announced. You will see the red part of the bar for our traditional farm program payments is increasing because these low prices result in higher payments under the ARC, especially PLC program for the current regime. So in terms of farm income, we're looking at a drop in farm income this year, no matter how you measure it. The net farm income figure that is most commonly cited has a relatively modest decline of about $3 billion as those larger government payments offset the effect of lower cash receipts. Another thing that's happening here that causes the difference between the red and the dark line here is that the red line is going to be net cash income, a cash flow measure that it doesn't consider how it changes inventories might affect farmers' bottom line. The dark line for net farm income is indeed going to make a correction for those inventories, since we had a back crop last year that reduced our inventories last year, assuming a more normal crop this year. That causes that to look better this year. That's the gap between the two. You see, for 2021, if there's no additional payments, we're looking at lower farm income, whichever of these two measures you choose to pick. Of course, that story could change depending on how we recover from the crisis. In other news, just real briefly, of course, we have to think about where we're going on the COVID-19 crisis, and none of us know, obviously. If I just looked at 538.com, collects some projections from different people who try to model this, and you can see very different stories. Some that suggest that future deaths are going to level off, and that we're going to, be able to talk about maybe putting this crisis behind us. But you see a couple of lines here showing at least the possibility that we could have a rapid acceleration of deaths again. We have seen a big uptick in cases here recently. Is that going to continue to be a problem with Dr. Fauci's discussion of up to 100,000 cases a day? Is that the path we're on? Or are we going to be able to get a hold of this, and it will have a huge impact for the economy as a whole and for the farm sector as well? For the general economy, again, the numbers we were using were based on IHS Markit's projections. We saw some recovery starting in the third quarter, but taking until well past the end of 2021 before we can get back to the level of income in 2020, let alone to the growth path we were on previously. On the good side, we've seen lower unemployment than feared earlier, and retail sales were up pretty strongly in the past month of reporting, but there's still lots of concerns. Unemployment's greater than during the Great Recession, and we worry about what's going to happen on the COVID side, of course. And then just real briefly on trade, the phase one deal with China, has lots of question marks right now. In 2017, during the first 4 months of the calendar year, the United States exported $6.2 billion of agricultural products to China, and $46.7 billion total. See the figures there for subsequent years. 2020 is up from 2019 a little bit so far in the first 4 months of the year in terms of actual shipments, but still well below the pace of 2017. Now, there's been lots of argument about this recently, and I don't pretend to know what's going to happen in the months ahead. There have been some additional purchases by China in recent weeks, so we might see things improve a bit relative to the 2017 level, at least in the months ahead. But it would take a very major change for us to achieve the targets that were set forth in the phase one agreement. If we really get to those targets, that can be a major positive for markets affected like soybeans, like pork, and other products that may benefit. If we don't see those targets being met, of course, that's going to be a negative for the system. And then finally, USMCA, the agreement between the United States, Mexico, and Canada, officially takes effect today. It reduces one source of market risk that had been out there. We don't think the impacts relative to NAFTA are all that terribly large for most commodities, but it is a big effect relative to what would have happened had we had no agreement whatsoever. So if the failure to reach an agreement had resulted in the elimination of the NAFTA agreement, getting this UMCA in effect does indeed provide some guarantees of continued trade between our North American partners. So final note, the world's changing very quickly, and our estimates prepared just a few weeks ago may already be out of date, such as USDA's report suggests. In most years, we do an update of our March baseline in August. This year, we did this release in June because of the snapshot of the COVID-19 impact, so we knew how important that was to try to get our handle on. We expect to do another release this summer. The timing is may depend on the fact we may stick with our August schedule, but haven't made a final call on that matter yet. So thanks. There's our crowd at FAPRI. I want to mention that we've been joined recently by 2 new full-time staffers. Abby Mefford joined us last month, and joining up officially as of today is Mark Rosenbaum. So welcome, Mark, to the staff if you're online today, and thanks for everybody who helps do our work. So I'll stop there and be glad to take questions.
Thank you, Pat. And we do have a couple of questions that have been submitted. If you do have a question, please go ahead and submit that there in the chat screen, or you can also send me an email at roacham@missouri.edu. So the first question, Pat, is getting at the COVID-19 pandemic, and it says, what are the potential impacts, or where rather are the potential impacts likely to be largest if we have a COVID resurgence in the fall?
So I think one of the big concerns is the sort of problems we saw this spring with the meatpacking industry, where plants that either had to shut down or had to operate at less capacity. You know, a lot of us are hoping that the new procedures put in place in those plants allow them to continue to operate safely for all the workers and be able to continue production, even if the overall crisis around the country is resurging. If that's wrong, that's a very big deal. Likewise, if we were to have to go back to having more lockdown activities, you know, people moving around as much, that would once again reduce the demand for motor fuel and therefore reduce the demand for ethanol, and that could have a big impact there as well. There's also concerns about just labor in general. Maybe not as big a deal for row crop agriculture as it might be in some other sectors, but for fruits, vegetables, and the livestock sector, having access to healthy workers, of course, is incredibly important.
Sure. Back to your point about USMCA going to effect today, you described that there'll be small impacts relative to the NAFTA agreement that we had been operating under, but what are the impacts that'll be most significant to agriculture?
So I do think we're going to see some modest effects on the dairy industry, for example. Depending on just exactly where things go with Canada, there's the opportunity. Modest increases are U.S. exports of dairy products to Canada. May see a little bit less competition from Canada in global markets as well. Some small effects on the poultry industry for the same reasons. In the case of Mexico, we had relatively few barriers with Mexico previously. So it's mostly a matter of making sure that nothing would come into place that can interrupt the trade that does occur there. There's been some concerns about the ability to sell biotech products in Mexico. And of course, that's one thing that we'll have to watch very carefully.
Okay. I wanted to skip back to the June acreage report. And according to the data in the USDA report, corn, soybean, wheat, and cotton acreage combined was lower than the 2020 intentions. So how is the acreage not planted to these crops being used, or is it being used this year?
So again, it is an increase from 2019. So we are talking about a lot more acres being planted this year than were planted a year ago because of all the flooding problems we had in 2019. But if you compare it to 2018 for the country as a whole, we're down roughly 7 million acres for all the principal crops put together. That's more than you can just explain by, some obvious things. There is a bit less acreage in places like North Dakota, which are indeed still affected by severe problems with the weather and flooding and so on that made it impossible to harvest crops in time last fall. But elsewhere around the country, it appears to us that at least part of the story is indeed these very low prices. If someone's able to claim prevented plant acres this year, it may be, for some cases, that's an attractive option for a lot of people. There's questions about their ability to successfully grow a crop this year. And then likewise, just prices matter. The fact that prices are lower does mean some marginal acres in a few places wouldn't have got planted this spring. They might have gotten planted under normal circumstances.
Okay. So with respect to the COVID pandemic and its effect on ag markets, what are some indicators that we can watch to get a sense of an answer to the question that you raised about, is the worst behind us?
So again, obviously, we've got the daily reports of a variety of indicators, including new cases. If new cases keep going up, that's a bad sign. Likewise, we've actually seen a decline in the average on deaths reported each day for the last couple of months. Concerned that could turn around here shortly, so that's obviously worth monitoring as well. But it's also probably important for the ag sector to pay attention to things like, what's happening with overall mobility. Are we seeing people driving as much? Are we seeing people continue to engage out there? And of course, what happens in meatpacking plants? Are we able to keep those plants operating at or near full capacity on a daily basis?
Great, thank you. So as you mentioned, CFAP will likely be a significant source of farm income this year. To what extent have producers participated in CFAP so far? And what are the types of producers, whether they're row crop, specialty crop, dairy, livestock, that have been applying for these payments?
So again, I guess $4.8 billion have been paid as of Monday. About half the total went to cattle, hog, and sheep producers. So that's a very different kind than we normally would see in agricultural program payments, where livestock sector either has no programs at all or has only small programs to support. The amount of payments to row crop agriculture so far relatively modest. It's just the figures this morning, and the actual number of people being paid in Missouri so far is fairly modest on the crop side. So I'm assuming that means there's still lots of applications in the process, and more payments will be coming in the weeks ahead. I'm anticipating a question here. There was USDA is only paying at 80% of the expected amount here in this initial payment, and hoping to be able to pay the remaining 20% as long as they're not going to run up against the overall budgetary limits they've placed on the program. One positive thing to think about is that as of today, USDA can have access to some additional borrowing authority. So if it did turn out that they were running out of money to pay everybody 100% of those initial payments, there at least is a possibility that they could tap additional borrowing authority to cover any shortfall there might be.
Okay, great. So last year, Missouri had some significant flooding problems, but in this year, a few areas of our state are abnormally dry, according to the latest drought monitor. So have weather events at all throughout the throughout the U.S. Been a significant enough to trigger changes in your outlook?
Right, and that's one of the things that'll drive whether we do an update in August or at some other time. If we expect to have a relatively normal crop this summer, it's probably necessary to update things. But if there is any concern about it, either abnormally large or abnormally small crop, that may drive a different decision on our part. We have seen, of course, some acres again this spring that got planted. I made a trip to Iowa last weekend, or a couple weekends ago, by way of the northeast corner of the state. And I was actually surprised to see how many acres in the extreme northeast corner were not planted this spring, again, because of flooding issues. I noticed the overall USDA figure showed a bit of a drop in principal crop acreage in Missouri relative to 2018, as well, probably for the same reason. Going forward, yes, we've had some pockets of drought in parts of the state here and around the country. So far, though, the USDA estimates or reports on crop conditions have been relatively favorable, above the 5-year average. Not outstanding, but at least average, if not better than average so far.
Okay, so as you noted, soybean trade to China hasn't completely recovered since the U.S. and China signed their phase 1 trade deal back in January. What's the reason for the slow rebound, and is it all attributed to COVID?
So COVID certainly was at least part of the story. There's no question about that. If you look at overall trade in soybeans by China, they have imported a lot of the last several months, but most of them have been coming from Brazil. We've had a big crop to sell, and they've captured a large share of that market. Of course, Brazilian sales will be heading downwards in the months to come, just for seasonal reasons. So one of the big questions is how much soybeans will China, should say, agree to purchase the U.S. in the final months of 2020. It would take a very, very big increase in those sales to come anywhere close to the kind of targets that were set forth in the phase 1 agreement.
Okay. Another China highlight that you shared was its significant decline in pork production between 2018 and 2020 because of the African swine fever. What's the updated outlook about when or if Chinese pork production will recover? And does China still represent a good market opportunity for U.S. pork?
So we've been talking about that internally. In fact, we're going to have an internal seminar about that next week to talk about this very issue. There are some signs that things are getting a little bit better, or at least less bad, in the Chinese pork sector. Some reports officially suggesting that inventory numbers of sows are actually turning up relative to where they've been, but we're still in a very deep hole and very vulnerable to additional outbreaks. There's been reports of some additional outbreaks out there, so whether they can turn that around is a big question. So again, if they're able to get their industry up and going again, that might moderate any demand they have for U.S. pork, but it also might mean stronger demand for soybeans and other feed products.
Great. Well, it's time to close today's webinar. Thanks so much, Pat, for being our speaker. Thank you for audience too. When you exit Zoom, you'll see a post-webinar survey will load in your browser. If you could please consider responding, we'll use the results to improve the webinar experience and also brainstorm future webinar topics. Again, within about a day from now, you should receive a Zoom recording of our webinar presentation that you can access in that email that we send out. Our next Engaging for Missouri webinar is scheduled for Wednesday, July 15th. Speaking will be Dr. Mary Hendrickson, who's an Associate Professor of Rural Sociology, and she's also a recent Fulbright Scholar to Iceland. She'll share a presentation titled Adapting to Thrive, What We Can Learn from Icelandic Farms. So thank you again for joining us, and have a nice Wednesday. Thanks, Pat.
Thank you.